everyone, welcome back to Mindful Investing. This week, the trade desk shocked investors, and I really mean shocked, with a 38% plunge in just one day after earnings. This is a stock I personally hold, one I have covered in my stock prediction series, and I went from being up 35% to being down 17% overnight. That's $1,100 loss in a single day for me. That's the reality of investing. It's not always sunshine and green candles. So in this video, I'm going to break down exactly why TTD stock crashed 38% after earnings, what I found out in their Q2 2025 results, and most importantly, whether I'm buying more, selling, or holding. Before that, let's do a quick recap of the situation. TTD closed at $87 before earnings, and now it's sitting at around $54. This is its second worst single day drop on record. Many investors are confused because the company actually beat revenue and EPS estimates. The problem wasn't the past quarter, it was the guidance and the management changes. First, a reminder, I've covered TTD before in my stock prediction series. My long term projections haven't changed yet. I'm seeing a 23% potential in 1 year and 182% in 5 years. But right now, the market clearly disagrees it. And the question is why? So let's get into it. The revenue came in at $694 million for Q2, which is a 19% increase from $585 million a year ago. For the first half of 2025, revenue is now at $1.31 billion, up 22%. That's actually ahead of Wall Street's expectation of $686 million. So, yes, this was a beat. Now, profitability wise, they are still holding their ground. GAAP net income was $90.1 million, up from $85 million last year. So, that's a 6% improvement. Adjusted EBITDA climbed to $270.8 million from $241.9 million, giving them a 41% margin, right in line with their historically strong range. And if you look at their earnings per share on a non-GAAP basis, they reported 41 cents versus 39 cents last year. For the first half, EPS is 74 cents compared to 66 cents. Another sign they are still returning value to shareholders. So financially, this quarter checks out. Growth across the board, margins are holding up, but numbers are only half the story. Let's move from the spreadsheet to the business itself, because operationally, TTD had some real bright spots this quarter. First, CEO Jeff Green doubled down on Kokai, their AI platform. He called it a game changer. It brings together first party data, acts as an AI co pilot for advertisers, and positions TTD perfectly for a world without third party cookies. Then there's connected TV, CTV, and retail media, two of the fastest growing segments in digital advertising, and TTD is expanding aggressively in both. We also saw more traction with OpenPath, their direct connection to premium publishers. That's important because it means advertisers can tap into high value ad inventory without extra middlemen, which can make campaigns more efficient. And one thing I always look at in ad tech is customer retention. TTD is still above 95% for over a decade now. That's not just good, it's exceptional. So, product innovation is a check. Expanding into high growth channels is a check. Loyal customer base is a check. This is where the story still looks very strong. But here's where the mood changes, because even with all that good news, there were some red flags that likely triggered this sell off. First is the growth. The growth is slowing down. Last year, Q2 revenue grew 26%. This year, it's only 19%. Still healthy, but the direction is downward. And for a high valuation growth stock, slowing momentum can be dangerous. Then margins took a small hit. Net income margin slipped from 14.5% to 13%. A big reason is stock based compensation, which jumped to $128.9 million. That's an expense Wall Street keeps a close eye on. Next is their Q3 guidance. Management guided for at least $760 million in revenue and $300 million in adjusted EBITDA. Sounds fine, but analysts were expecting more upside, especially after such a strong run in the stock. And since they didn't provide a gap reconciliation, it leaves some uncertainty around the true bottom line. We also can't ignore the CFO transition. Laura Shenkin is stepping down after more than a decade, replaced by Alex Kayal. Even if the change is positive long term, leadership shakeups in finance roles can make investors nervous in the short term. So, when you stack it all together, slowing growth, margin pressures, cautious guidance, leadership change, and combine that with the fact that stock had run up 56% in 3 months, well, that's the perfect recipe for a massive drop when expectations aren't blown away. Now, let's talk about the market reaction because this wasn't just a bunch of retail traders panicking and hitting the sell button. Institutions sold heavily after earnings. Why? Many big funds and asset managers need to show short term results to their clients. If a company's growth slows even slightly, they'd rather lock in the gains and move on to something with faster momentum. And remember, TTD stock had been on fire, up 56% in just 3 months, heading into earnings. That means a lot of these big investors were sitting on profits. The second they saw slower growth and cautious guidance, they hit sell to lock these profits in. At around $54 today, the stock has given back almost all of its gains from the 2024 to 2025 rally. And historically, this isn't new for TTD. We saw similar drops in 2020, twice in 2021, 2022, and in 2024. So volatility is just part of the TTD story. But the question is, what do we do now? Here's the thing, despite the drop, my long term projections haven't changed. Based on my model, I still see a 1 year price target of $67. That's about 23% upside from here, and a 5 year price target of $152, which would be around a 182% return. You might ask me, why am I not lowering these targets? Because the big drivers for TTD business are connected TV, AI powered ad tools like Kokai, and retail media are still in growth mode. The fundamentals of the digital ad shift are still intact. It will have a short term pain, but the long term potential is still very much alive. So, here's exactly what I'm doing. I'm not selling here. Locking in a loss after a 38% drop doesn't make sense to me when the fundamentals haven't fallen apart. Instead, I'm keeping an eye on the $44 support zone. This is a level where TTD has bounced multiple times in the past. If we get a retest of that area, I'll likely add to my position. Why? Because historically, these massive sell offs in TTD have been buying opportunities if the business remains strong. And right now, it does. So I'm patient, I'm disciplined, I'm ready to act when the setup is right. This drop hurts. Losing $1,100 in a single day on one stock is never fun. But panic selling after a big crash is rarely the right move. The business didn't collapse. Expectations just got ahead of reality. Combine that with cautious guidance, a CFO transition, and some short term profit taking by institutions, and you get this kind of extreme reaction. So, to everyone asking, what do we do now? My advice is don't make emotional moves. Revisit your thesis, check your position size, and only add if the fundamentals still match your expectations. I'll keep tracking TTD and will update you if my stance changes. But now I want to hear from you. Are you buying the dip, holding your shares, or selling? Drop a comment below. Let's talk about it. If you found this breakdown helpful, hit that like button and subscribe. It really helps the channel. That's all for this video. Thanks for watching, and I'll see you in the next one.